Revenue per share loss guidance for the next year, for full year 2018, did miss some forecasts. And I want to read you a quote from one of the analysts, Wedbush. She says, remain on the sidelines on the stock until the new subscription model can settle into a more consistent, predictable pattern. I want to ask you, Amar, first, when will this occur, this consistent pattern?
Well, we're on the path to delivering that. I mean, if you look at our annualized recurring revenue growth, it's growing very nicely, and recurring revenue is now 84% of our quarterly revenue, on track to get to 90%. So, we're building the right long-term results. The change in the outlook for 2018 really had to do with some decisions we made actually to change short-term revenue for long-term revenue. So, they were as designed, and we are very confident about our long-term targets.
This is, of course, something we've tracked with many a company making that shift to the cloud. You see it in Oracle, you see it in SAP. I want to ask you, Andrew, really, will you stop selling licenses altogether? How much will you shift to a cloud-based model? Can you break it down on a revenue sort of basis?
Well, essentially, we've already stopped selling perpetual licenses. We only sell a very small number of perpetual licenses. All of our mainline products have already done the cutover. I think the thing that we're working on right now is moving the customers who are maintaining their perpetual licenses. It's another form of subscription we call maintenance. Yeah. They pay us a fee every year, and we ship them a new copy of perpetual software. That's the base that we have to now move over. So what we did in the earnings call is we announced our new program to move the maintenance base over to the pure subscription model as well. So that's going to be in process, and that will basically be the last vestiges of the perpetual model in our business.
Right. Amar, does it therefore mean the 3 million we see in subscriptions is going to grow significantly?
Yes, we anticipate it'll grow at 20% compound annual growth rate. So I think we're seeing sustained momentum, both from new customers taking advantage of subscription, and, as Andrew mentioned, existing customers switching from maintenance over to subscription. So I think we are on track to exceed over 5 million subscriptions in the 3-year time frame.
Andrew, talk to me about the new subscribers. Talk to me about the new sectors you as marketing chief are pushing into. Construction, manufacturing, that seems to be the way you're going. How much does it ebb and flow with where the economy is?
Well, obviously, we do go a little bit with the economy, but the really cyclical part of our business is the low end of our business, the people that buy in small one or two person companies. That's where we see the most cyclical behavior. Other parts of our business in construction and manufacturing are actually really stable, and that's where we're seeing a lot of the growth, particularly in construction. One of the things you actually heard in our earnings report is we saw a 3 times growth or 3 times more subscribers from our cloud products in Q4 than we saw in any other quarter. And those are the products that are squarely positioned on construction, like BIM 360. We actually saw the same kind of performance in our manufacturing project products, which are Fusion 360. We actually saw 150% growth year over year in the subscribers to those products. So we're seeing strong growth, and really we're not seeing any secular or macro headwinds at all in our business.
Talk to me, Amar, about the bottom line. We were hearing about the revenue potential, the subscription potential. What about the profitability? Is that going to start to pick up as and when?
Absolutely. And so as our annualized recurring revenue base keeps growing and more of the revenue becomes recurring, people can look and predict our profitability, which we've tried to, through our Investor Day and other presentations, given an indication that we'll reach $6 in free cash flow per share by FY20, and the metrics that we delivered against it, the earnings, show us on track to deliver that. So, on a P&L basis, on the traditional accounting side, it looks like we're at a loss right now, but everything is as designed and as heading towards the profitability that we predicted for the long term.
Andrew, just how tough was the Investor Day? You've been under some pressure from activist investors in particular. How, as a new interim co-CEO, do you deal with that, and what sort of pressure do they put on your business model?
Well, look, the investor days are always an opportunity for us to explain what we're trying to accomplish long term. And one of the things we were getting from our investors, especially over the last 18 months, was we don't understand the transition. We don't understand where the business model is going and how you're doing it. So what we did is we spent a lot of time at our last Investor Day giving them detail about the business. And one of the things you saw was our stock price ran up pretty dramatically afterwards because people started to get a little bit more detailed understanding about what we were doing and some of the underlying mechanics. And that's what you have to do sometimes to get people comfortable with what's happening. You have to give them the details.
Very quickly, gentlemen, Amar, to you. Are you going to remain CEO? Will Andrew be CEO? Will you be fighting it out? Can you be co-together?
Oh, we are, working very well together. So, it's up to the board. They're running a process to figure out who the next leader will be. But, Andrew and I have worked together for 15 years or more. And, we're having a blast running the company. We've been co-architects of this business model transition, and, we're going to keep driving it.